Hello and welcome back to the Note. Well, it appears the long-promised August doldrums are more or less upon us. We've had a quiet day across world markets. Stocks did fairly well. Oil continues to languish. But I think it's a good opportunity to step back and take a look at the growing power of indexes in world markets. It's the subject of a long series we're currently rolling out in the FT. So I think it's worth taking a look at an interview I did last month with Alex Matturri, who is the CEO of the largest indexer of them all, S&P Dow Jones. Now, I started by asking quite why it's necessary for S&P Dow Jones now to calculate more than 1 million indexes every night.
Well, I think for us it's a couple of reasons we've ended up with that many. Number one is we produce indices across all the asset classes, not just equities. So that by definition expands it. And secondly, I think there's just demand out there. I mean, clearly not everybody's using all of the million indices we publish every night. But from a production standpoint, once you produce them, doing them in different currency versions and different flavors of them, they're available for customers to use. And there is demand for a lot of these different indices. So,
now, how do you compete with other index providers? What are the demands on you at the moment? Are you looking primarily to meet the needs of product providers or of ultimate investors?
Well, I think our business is much more tied to indices used for investment products. I think that's always been part of our business strategy. Hence our expansion into new asset classes like fixed income, commodities, volatility. There's demand out there for indices there. So I think all the index providers compete and also have their unique attributes. For us, it's product, but we also create a lot of indices that are used for benchmarks in local markets with our exchange partners, for example.
Now, is there any competing on price, and is there any competing on brand when it comes to indexes?
I think brand is very, very important because brand stands for the history that you bring in the business itself. I mean, people know that if they come to us, they'll understand how we create our indices, how we distribute our indices, they'll understand the methodology. So, you know, pricing, certainly it's a competitive business. So if we're mispricing our products, the business goes away. But I think brand stands a lot about what our business is all about.
Now, given that so much money now tracks your indices, particularly obviously the S&P 500, what are the risks that you end up not reflecting the market but leading it? Is that a risk, and what do you do about it?
Well, I think people understand the methodology behind how the 500 itself is developed and calculated and updated, and the new stocks that come into that. That's pretty well known. It is luckily the most widely used index in the most liquid market in the world. So I think the data shows that the index represents the U.S. marketplace. There's so many products tied to it. But certainly when you get away from the 500, understanding how the markets operate, that we're developing indices, liquidity is an issue in some smaller markets, and that goes into the actual design of the indices.
So particularly in emerging or frontier markets, you do have to be careful you don't lead the market.
Absolutely.
Where is the next frontier? You're already over 1 million indices. Where are you going to grow business? The one big area looking at who is used by benchmarks, by mutual funds these days, where yourselves and the other big independent index providers aren't in a dominant position yet, is in fixed income. Is there an opportunity for you there?
Absolutely. I think we're very committed to developing that business for us. It's been a strategic goal for us over the last few years. I think the changing regulatory landscape has allowed us a window of opportunity as people question, are there conflicts of interest in indices that are priced by a trading desk, that are traded by a trading desk, and the index business all being kind of wrapped into the same organization. So I think people have come to view the independent index providers like ourselves and some of our other competitors as being a better alternative because we're free of those sort of conflicts of interest that may exist. So for us, that's a good opportunity to develop indices. And as I said, we've launched already quite a few of them. We announced the S&P 500 bond index, which is the first time. We've been able to develop an index and look at companies both from the debt side and the equity side using the same lens. So that's innovation.
Okay, that's interesting. In terms of conflict of interest, presumably ultimately what you're saying is given the LIBOR scandal, people are now much more alive to the possibility of conflicts of interest than they were before. They might see you as some kind of a guarantee against a repeat of the LIBOR scandal. We
certainly don't have the conflicts, right? We don't trade, we don't issue products, we have no vested interest in the outcome or direction of an index. We just publish indices.